Hello, Dave Keller here with StockCharts.com. Welcome to the final bar. The market recovering very nicely today with an impressive rally coming out of last week's destruction going into weekend. Thursday, Friday, a little weaker. Today was all about follow-up to the upside, and I feel the concern is if you're bullish, you feel validated that we've had a nice pullback. If you're bearish, you feel like this could be the first of multiple waves down. So we'll try to look at the charts together and see which we think is going to happen next. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller, here at StockCharts.com in a somewhat rainy Redmond, Washington. Thanks for joining us every weekday after the close to make sense of the markets together, try to follow these trends, understand the short-term movements in today and how they line up with the long-term trends and how they've evolved. And when we think about momentum, there's certainly been increased volatility, increased uncertainty, if you will. I feel like the beginning of last week was a position of strength, the market going to potentially new highs for the swing. Thursday, Friday sort of reversed that with a lot of bearish engulfing patterns, a lot of short-term weaker signals breadth that was climactically negative on Thursday. And then the week becoming basically a bearish outside week. So it set us up to be further down today. And looking at the futures overnight, they certainly were trading lower. But we pretty much opened at the lows of the day, and from then on rallied very, very nicely to close about 0.8% higher. So we're going to take a look at all those trends and see how they've changed during the trading day, and again, try to build on what we talked about on Friday's Wrap the Week section. I want to just continue on, remind you of all the great guests that we have on Stock Charts TV on this show and then elsewhere. Earlier today, our latest episode of Behind the Charts ran on the channel. That's featuring Mike Turner from Turner Capital Management. Mike applies a rules-based technical system to his money management, his research operation. So if you've ever thought about that sort of approach, it was pretty interesting to hear how he came about and built out his technical toolkit. Then on the show tomorrow, on the 16th, we have Jeff Greenblatt from Lucas Wave International. On Wednesday, Jay Pettit from Charts Avenue in Singapore. And then Thursday, Bruce Powers joining us from the Itero Group. Also, just as a reminder, coming up mid-July, the week of July 13th, our special week, our special event on Stock Charts TV called Charting the Second Half, where we'll ask all of our contributors a series of special guests and a special panel at the end of the week to help us understand what's in store for the markets for the second half of the year. And this first half of the year is ending in quite a position of uncertainty and excitement. So it'll be interesting to hear what all of the contributors think about the second half of this year. It's coming up to the week of July 13th. Let's get to our market recap here. As I mentioned, stocks certainly impressed today with the S&P closing higher, 0.8%. That puts it at 3066 and change. The NASDAQ led the way even further. So the NASDAQ 100 was up over 1%, closing around 9777 for the NASDAQ 100. Mid caps, small caps up even more. So small caps led the way higher, up 2%. They turned positive midday and just really didn't look bad back. You know, it's interesting when you think about small caps. We'll talk about the relative performance of small caps. I was on a panel earlier today, and we were asked about the confirmation or the non-confirmation with some of these different benchmarks. And, you know, is it concerning that small caps don't confirm new highs in something like the NASDAQ? I mean, is it concerning in terms of validating by looking at confirmation across different benchmarks? Absolutely. Is it less concerning because the markets have shown that they can rally without small caps being a meaning part of it? Absolutely. So it's sort of correct in that it's a potential divergence, but also correct in that, you know, the market can move higher without small caps. Today's not been the case. And if you look at the last couple of weeks, small caps have actually done pretty well, right? And that's a big departure from previous cycles where we've had small cap underperformance, this mega cap led rally. So today was a bit more of a risk on move. And again, my question when you look at the markets is, do we just validate everyone's perspective? If I'm bearish and I'm just looking for limited upside and potential for downside, I think the last couple of days feel like the first impulse down coming out of an island reversal up here. That's a gap up to sort of a series of sideways days, and then a gap back down. So you have a gap on both sides of it. Tends to be pretty negative. You have what you might call a breakaway gap here, sort of this impulse move lower, and then today is sort of the bounce off the 200-day, which makes sense, right? If you're negative, that's pretty standard. If you've had sort of the bounce before the next leg down. However, if you're bullish, and this is what I took away looking at all the individual stock charts over the weekend, is that, if you look at a lot of individual stock charts, there are a lot of what appear to be buyable pullbacks in a lot of stocks. And it's not just in particular sectors, it's kind of across the board. So the problem is, and I think the challenge for all of us is, if the market goes materially lower, the beginning of that, or if it goes materially higher, this would actually fit in both of those scenarios, right? This is pretty good. If you're bullish, we needed a break, we've gotten it. If you're bearish, we need some sort of heavy moves down, and we've had those too. And so I think the next move is what's going to be crucial. Either we're able to recover, we're able to fill this gap and get back to 3,200. I think that will solidify more of a bullish phase, or we break down below 2950, which would take us back below the first Fibonacci support level. That would take us below the 200-day moving average, and then I think you'll see a lot of capitulation lower. So I think a lot of people are expecting, support in this sort of amber-colored area that I've indicated here. So right now, I think it's wait and see what this next leg will be. Let's look elsewhere from a macro perspective. What's happened today? Bonds finishing flat. They were much stronger out of the open. They ended up finishing flat for the day, but overall had opened the day a little bit stronger. 10-year yields around 70 basis points. And the U.S. dollar actually continued its downtrend. I've talked with someone earlier today about non-U.S. markets, looking at ADRs and looking at EFA and other assets. That weaker dollar story certainly playing into that overall idea of U.S. underperformance potentially. Oil stronger today with the U.S. up 2% and gold flat for the day. We're going to look at gold a little later in one of our 3 and 3 just to see this pullback. Again, we talk about buyable pullbacks in individual stocks. Arguably, you could say the same thing for gold, which has had a nice run and then pulling back to a potential important support level there. And I'm talking about the macro perspective, and we'll finish this this recap up. And then, as you know, on Mondays, we'll go next to sector rotation, and then we'll finish the show talking about individual stocks in our shifting stocks segment, but keeping it at a high level. When I talk about these divergences, here we're looking at a candle glance page of the equity market indexes. These are the major benchmarks, U.S. benchmarks, that I tend to follow. And it starts with the S&P, goes to the NASDAQ Composite, New York Composite, and then you can see as you go through all the different tickers. Some you may know and some you may not. But overall, you can see there's sort of 2 buckets. Bucket number 1 are indexes that have eclipsed their February high. And there's only a couple of these, right? The NASDAQ Composite here, which is testing 10,000, pulling back there. The NASDAQ 100, which broke 10,000 and has pulled back from there. And glancing across the list, yep, that's actually it. Those are the only 2. So the tech-heavy NASDAQ Composite, NASDAQ 100, both have made higher highs, obviously driven on the strength in the technology sector, the XLK. All the other indexes have made lower peaks. So, traditional analysis would be Dow theories, just looking at the Dow Industrials and the Dow Transports and identifying when there's a non-confirmation, when one breaks to higher highs and the other does not. And what I would call the new Dow theory is looking at the S&P as one of those benchmarks and the NASDAQ Composite as the other one. If you look at those 2, you can see how the S&P here potentially establishing a lower high here in June, and the NASDAQ Composite establishing a higher high in June. And that idea, that concept of non-confirmation, the NASDAQ going to new highs and it's not confirmed by the S&P, which basically includes all those other sectors that make up the U.S. equity markets, suggest overall some long-term weakness. Now, again, one of the challenges I think we all have is even if it's a longer term, a weaker environment, there's still a lot of career-busting moves that can happen within the context of a quote-unquote, weaker long-term environment. And I think that's the challenge for all of us, is identifying some of these maybe shorter, medium-term trend movements and where they've evolved. So again, for me, I think it's important to have a line in the sand. As long as the S&P continues to make higher highs and higher lows, we're in pretty good shape. But a break below 2950 would certainly change the characteristics of that sort of tactical uptrend and make me think a little leaning more negative. Let's go to our next segment, sector setup. So what we like to do after talking about the macro view on Mondays is switch to the sector rotation view. For this, I like to use the RRG charts, the relative rotation graphs. As a reminder, if you're not familiar with this, Julius de Kempener, one of our contributors, created this visualization and has promoted it for a number of years. I followed his work since he was a publishing analyst at a brokerage in Europe, and I followed his work at Fidelity, and have enjoyed keeping in touch with him, learning from his methodology. So check out his show, Sector Spotlight, if you're not familiar with what we're going to talk about here. But overall, we're looking at the ETFs, these sector ETFs, and how they're rotating around the S&P 500, which is here in the middle. I'm looking at a weekly view, which is a little longer term because I'm just trying to understand the structural movement of these different sectors around the benchmark. And if you look at the last 6 weeks or so, you can see what's happened are the consumer staples, utilities, healthcare. You can see how they were the leading sectors, but have rolled over to head southwest, which is sort of the direction of deterioration. Technology has stubbornly remained right around here, and it's sort of whipped back and forth. And if you think of the relative strength of a chart like Microsoft, this is why that has sort of looked like that. Overall, the relative trend has been very positive for Microsoft, but it's had sort of fits and starts. So there was a period there about a week and a half ago where it looked like this was a big relative distribution breaking to new relative lows for the last month. But you can see since then it's popped back up there. And a lot of charts in tech have sort of looked like that. And that's what's made the RRG have the technology sector sort of stubbornly remain there. While other sectors have rotated lower, the XLK still is the furthest to the right now, which means it's the top performing sector on a relative basis. Further to the right is the pure measure of essentially the purest measure of relative strength on this methodology. But what's coming up close are communication services, consumer discretionary, and those are the sectors where you've seen a lot of names that have had pretty good setups, and it's things like Alphabet, Netflix, things that have broken up and maybe stabilizing a little bit on a price basis, but holding up pretty well. Also, and I guess the next real bucket, besides the things that are really beaten down like utilities and real estate, the things that have emerged are these sectors, these value-oriented sectors that really came up strong out of the lows. Industrials, financials, and energy. Industrials, you have things like Boeing, but you also have the airlines, all those stocks that sort of, were beaten down, avoid type of names that all just dramatically came up higher recently. And if you bring up some of those charts, we'll bring up American Airlines here. If you think about it, they had a huge run up, AAL in particular, right up to the 200-day. That was a distribution day there. And since then, it's sort of stabilized, come off a little bit. But you can see the trend in the relative strength still relatively positive for the last 4 weeks for sure. And so the question with a chart like this is, was this the viable pullback to 14 before the next move higher, or is this the beginning of the next continued wave down? Or are we just getting a bounce out of the lows? And again, I think the next move is what tells you that. Either we hold above something like 14 and we continue higher, or we break down there, and that's when it tells you that there's further downside to come. I think the challenge of something like American Airlines, these are huge percent swings that we're looking at here. So it's not just a quick reversal. I mean, this is sort of flat for the day, but these are 10+% swings up or down on these big days, because it's going from 14 to 17 in one trading session. So I think the challenge is there's a lot of volatility, there's a lot of movement there, but I think whether or not we see those prices stabilize and find support now that they've established maybe a swing low will be pretty important. After looking at the RRG, we're going to look now at the sectors on a candle glance page, which is basically the 30,000 foot view, see how each of these are moving. If you think about the exercise we did looking at the broad market indexes, and we saw how the NASDAQ 100, the NASDAQ composite had already made higher highs, everything else had made a lower highs. We could do that same sort of thing with this look, and you can see only a couple sectors have actually broken to new swing highs. Technology is obviously the most obvious one, because this is really what's driving the NASDAQ 100 higher is the overweight in tech, and you can see that tech has broken above its February highs, but back below it. And again, the question now is this the next pullback on a further uptrend that continues, Or do we start to break down through some of those recent swing lows? Same thing with consumer discretionary. And what's interesting about the consumer discretionary chart, you have that island reversal, the same as you do on the chart of the S&P 500. So this is a sector that actually gapped higher right above the highs from February, since then has gapped back down. Now today was obviously a pretty good accumulation day as people bought through the session and it closed near the highs. Again, the question is, do we get follow through and do we break above the lower end of that gap? Do we re-enter that gap, get above the sort of that 130 level and push back up toward the previous highs? Or is this a pause before we break down through 122 and go through further lows? With a lot of sectors like the XLY, you have something like the 200-day moving average not too far below where we're at. So a couple session or two that's a little weaker could take us right back to that key support level. And again, whether or not sectors like this can hold that level, I think will be really important. But other than the XLY and the technology sector, the XLK, other than that, most things have yet to eclipse their high from February. Communication services may be the closest, but it did not breach it. That's at 57.50, a little above the high that we made a week and a half ago. So again, that's still sort of unable to break to new highs. And the rest of these are actually relatively muted. A lot of them below their 200-day moving averages. You can see a number of these that I'm highlighting here. Industrials, for example, financials tested their 200-day and either just broke it or stabilized right there. Utilities as well, before they've now continued a little bit lower. To finish up this discussion of sectors, I think healthcare is a really, really interesting one. We've talked about the resistance, and this is a sector, while others have sort of fluctuated around their levels, the XLV is one that really tested, almost to the penny, these previous highs from January. From February, we then completed the V bottom. We came right back up to that point, and now we've broken to a new swing low. And so if you think about this as a big range, you have the 200-day moving average below, you have the previous peaks around 104 to 105 above, and one of those is going to break at some point. And I think that's the direction of momentum. That's what you'd want to follow. The challenge, if you own healthcare, is this right here, which is since the big run up that you saw March, April to the end of April, which was really at outperforming on the way down, but then continuing to outperform during the recovery, the relative strength has been pretty brutal. And even though there are certain stocks that have held up, maybe in the biotechs that have held up okay on a relative basis, as a sector, it's really, really struggled. So until you see an improvement in the relative strength, I think you have to be a little more tentative about expecting a lot of outperformance from the healthcare sector. But I think right now it held the 200-day for today. I think whether or not it's able to continue to hold that will tell you about healthcare as a sector and whether that's a decent bet going forward. That's our sector setups. And again, trying to just make sense of some of these different patterns, looking for lines in the sand and identifying some key points to pay attention to. And on a sector basis, using those ETFs, I think you've got plenty to think about. Let's take a quick commercial break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the show, The Final Bar. This is Dave Keller here at StockCharts.com. Thanks for joining us for the show every day after the close. As a reminder, we have a mailbag segment a couple days a week. We'll do one on Tuesday's show. Just shoot us an email if you have any questions on the markets, on a particular chart, particular stocks you're looking at, overall investment theory, or whatever you're looking at. We'd love to help you navigate these markets. And so just shoot us an email, thefinalbar@StockCharts.com. Or look us up on Twitter. Just tag us in any comment at FinalBarSCTV. We'll take all those questions and answer some of them on the air tomorrow. Our next segment is called Shifting Stocks. So again, on Monday, we do the macro top-down approach, which we did earlier. We do the sector rotation approach, which was second. And now we're going to go to the bottom-up stock picking approach. And I don't know what your routines are, but for me, every weekend, I try to go through the entire S&P 500 one by one. I do it by sector and I do it by group. So I start within communication services and I look at some of the communication names and the media names and the old school telecom names. And then I go to consumer discretionary. And even if you just trade the broad market, or even if you just look at sectors, I tell you, there's a lot of signal to be gained by looking at individual stock charts, because a lot of times the patterns will emerge on individual stocks then they're reflected within the sector, and then you see them emerge in the larger benchmark. And a lot of times at turning points especially, you'll see inherent strength or weakness in some individual stocks before it becomes more and more prevalent across the market. So can't stress it enough. I would think about each of those three, top-down, sectors, and bottom-up, and see where you may want to spend a little more time in your weekly routine. Let's get to some of the takeaways that came out of my work over the weekend. And again, I tend to look at a bunch of charts and take a shorthand group of notes, just making sense of patterns. And, if I had to summarize the market in one chart right now, I guess I would look at Starbucks as a decent example of that. And the reason is because, like many stocks, like in the financial sector, for example, Starbucks, really felt pain going into the March lows. That's totally fine. It's interesting to note, actually, Starbucks had a higher low on March 23rd, which was the eventual market low. So you actually had a bit of a divergence there. Starbucks led the way higher. And on a relative basis, the month after the low actually did very, very well. Since then, been sort of a market performer, underperformed a little bit if you look at the last couple of weeks, but now it's sort of trapped in this area. And when I think of the overall market, I think we're sort of trapped. We're sort of in this a range of sorts. For Starbucks, you have the 200-day moving average, and now you have the high from last week as a pretty good upside resistance. So it's sort of in the 81 to 83 range. And this is where you'd probably expect some resistance if we return back up to those levels. On the downside, we've traded down now over the last week down to the lows that we saw here in April and May. So after the big run out of the lows, Starbucks sort of stabilized in this 71 to 70, 77, 77.50 level. In that range for about 4 weeks before breaking to new highs and approaching the 200-day. So now we've reapproached the lower end. And so now you have this nice sort of range between the peaks from last week and the lows from May and the lows from last week. And so I think the question is, which way do we break? And I think looking at charts like Starbucks, if you see these types of names eclipse their 200-day and break to new highs, I think that tells you the S&P can retest its highs, 3,400, if not stronger, and that there's just a lot of pent-up demand for stocks. And this is an obvious result of that. If, however, we break to new swing lows for whatever reason on stocks like on charts like this, I think that tells you there's an inherent weakness there, that people are enjoying the fact that they might have missed that first leg down, but they're taking some profits today. And the breakdown of those support levels suggests a lot of potential downside for the broader market. So Starbucks might be a really interesting one to pay attention to see which way it breaks out of this congestion area. Very quickly through some other names that I found really interesting. Within consumer staples, it's been sort of a forgotten sector of sorts. This was a favorite of a lot of people coming out of the market lows because of the leadership, especially as the market sold off. A lot of names like Campbell's actually rallied, which was impressive. And this is when the relative strength went vertical. It felt like consumer staples was going to be the new sector for leadership. That changed very dramatically after the March 23rd low, and you can see that basically Campbell's rallied along with the market, but since then has sort of stabilized. A lot of the groups, a lot of the stocks in this sector, things like Smucker's, Costco, Walmart, sort of breaking their 200-day moving average, which is concerning. I'm looking at a chart like Campbell's to see if it's able to hold it. All else being equal, stocks that had been doing okay, that are pulling back to an ascending 50-day moving average, pulling back to previous support, an RSI around 40, that tends to be a pullback range within a longer-term uptrend, pretty decent setup. And so overall, as a more of a bottom fishing type of buying on the weakness candidate, might not be too bad. But again, that's assuming that 47 level holds. I think if it breaks that and follows other charts like Costco and Walmart in the group that have just started to break down through their 200-day, that'd be a bit of a concern. So I think it'll be interesting to see if consumer staples charts like this will be able to hold it. Another one that might be interesting to look at is PM, Philip Morris. This is actually more of a consolidation of sorts, right? You have the 200-day above, and we've put in a bit of a higher low today, potentially, with a nice rally going into the close. So again, we have that ceiling above where we're at to see whether or not we're able to break above that. I'm going to go very quickly through some other charts here. Switching gears to financials, Morgan Stanley. If I had to summarize the financial sector, it's hard to do that with one chart because there's a number of different charts patterns that were represented there. But I think Morgan Stanley represents a really interesting one. When we talk about the broad market and said this is either the pullback, the next pullback within a further upside, and stocks like Morgan Stanley find support at their 200-day and rotate higher, or this is the bounce before the next leg lower, and stocks like this break their 200-day. If I didn't already proclaim Starbucks as sort of the chart to watch, Morgan Stanley might be a close second, because it's had this nice breakout and now it's retesting the 200-day, and either that holds and we rally and break above 52, or it breaks down below 44. And I think I'd be concerned about financials as a sector, and then further on there. And then the next bucket of I combined bucket and basket there. The next basket of stocks I talk about are within the healthcare sector. Some interesting setups here as well. I think within biotechs, you have charts like Amgen that had, that sold off. They've round tripped. They weren't really able to get above their previous highs. And if you look at the patterns here, just the candles or the bars, every time it tried to break to new highs, you can see the next day was just a big distribution. It happened a number of times in a row. So clearly a ton of resistance around that 240 to 245 range. It's now pulled back to the 200-day moving average, the RSI down to 40. So, again, in a vacuum, I would consider that to be a pretty buyable sort of chart. That's the type of, short-term weak, but longer-term pretty constructive that I could consider pretty interesting. What concerns me is also within that group, you have something like Biogen, which is already broken down through the 200-day. So it's almost had that similar-ish pattern, but it's already broken down through swing lows and broken down through the 200-day. You also have something like ABBV, which is, still way up in the, testing the previous highs. It's had this, what's called a gravestone doji candle, if you're into your candlestick analysis, where you break higher but open and close almost at the same price level at the lower end of the day. You could also maybe consider that a shooting star candle, depending on how you want to classify it. But both of those short-term negative, but now it's pulled back nowhere even near the 50-day because it's appreciated so well. So holding up pretty well. And also I would say within there, you have something like ABMD, which is looks unlike most other charts out there. And in a period when a lot of stocks have now pulled back significantly and are doing things like testing their 200-day, something like ABMD that's nowhere near its moving averages and it's above two upward sloping moving averages, pretty decent. What's interesting about ABMD is it was recently extremely overbought, which is pretty rare right now. So it's pulled back a little bit, which is normal, but you'd expect at least one more leg higher on a chart like that. I have to wrap up, but I just want to finish with a couple more technology charts. Again, if I had a third one besides Starbucks and whatever else I've already thrown at you as the Morgan Stanley, I think those are the first two. The third one would be Applied Materials. This is a semiconductor stock broken above the 200-day, now testing it from above. So I think this, if you see things like AMAT, things like Morgan Stanley, things like Starbucks able to hold their support, I think there's a lot of potential upside here for stocks, a lot of pent-up demand, and that would prove it to me as a stock picker. If those stocks start breaking their 200-day, I'll start feeling a lot more bearish. I think validate some of the weakness we've seen on the breadth side, because this shows you that individual stocks are not getting the buying, not getting the demand that would be able to keep them above that key trend following device. That's shifting stocks. We need to wrap up the show and go right to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1, we talked earlier about the new Dow theory. And again, traditional Dow theory is looking at the Dow Industrials and the Dow Transports and seeing whether or not they confirm or don't confirm each other. What concerns me from a longer term perspective, this is certainly a longer term view, is you've had the NASDAQ and the NASDAQ composite going to higher highs, the S&P going to a lower peak at this point. If we break above that high, that sort of invalidates that. But if this is confirmed as a short-term swing high, which we'll have to see how the rest of the week plays out, I think you have a non-confirmation that overall points to structural weakness in the markets, not structural strength. Chart number 2 is small caps. We talked about the relative strength of small caps, and even though they pull back a little bit into the end of last week, overall the relative strength has started to improve over the last 6 weeks or so. And I'm looking at the price of the IWM, which is the small cap ETF. You see it broke above the 200-day moving average, came back down below it, and now we are trapped between two key levels. We have the 200-day moving average. We have resistance around 150, 250. That breaks to the upside. I will feel pretty good about further upside in stocks. We also have a trend line starting with the March lows and connecting with the May low, and we're pretty close to testing that. If we break below that, break below the 50-day, I think look out below for further weakness in small caps and also for the broader market as a whole. Finally, gold. We didn't talk a lot about this earlier, but I mentioned the pullback in gold. And again, in a vacuum, knowing no other chart than what I see here, I see a long-term uptrend, and I see a chart that's pulled back to an ascending 50-day moving average. I see a 200-day moving average that's been sloping higher. Overall, the trend in gold has been pretty positive. It's underperformed because it really hasn't made a new high significantly since back here in April. I think if and when we get a rally off the 50-day, push to new swing highs, I think that would be a very interesting breakout. And again, traditionally, you could expect that breakout in gold with a potential weakness in stocks, and that would be poetic as a safe haven. That's our show for today, folks. Thanks so much for watching us every day after the close on the Final Bar. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.